Right, so I'm going to continue with the 13.5. I'm going to be looking at both bonds and mutual funds in this video. All right, so a bond is different than a stock. All right, so it's like you're lending the company money and you receive an agreed upon rate of interest for the use of your money. All right, you say that you're buying a bond, but in reality, you're giving them money to use, and then they'll pay that amount back to you. Okay, so they'll give you that face value back, and then also over the term of the loan, they'll pay you a fixed rate of interest as well. Okay, so the bond is issued with an agreement about how long they can use your money. And then after your bond matures, so after they've used it for that length of time, then the principal is paid back to you, the face value of it is paid back to you. And then in addition to that, they're going to pay you some interest. Okay? And the number of times that interest is paid out within a year really doesn't change anything. You're really just using simple interest on the bonds. No compounding occurs, even though it sounds like a compounding problem because they'll say things like they're going to pay it semi-annually. But the interest is really just simple interest. It's just they might pay it monthly or they might pay it to you twice a year or something like that. So for bonds, when you're doing the return on the investment, it's just simple interest. You're just think PRT. So $5,000 is what they borrowed. The interest rate was 7.5%. So remember, per means divide by per cent means divide by 100. So move the decimal 2 places. So 0.075. And you're going to let them have your money for 10 years. You don't need to worry about the semi-annually, the n equal 2 thing, because the interest is calculated just using the simple interest formula. So if you want the total return on your investment, okay, so over the time they hold your money, you'd actually make $3,750. Now they're going to pay you the $5,000 back. And on top of that, they're going to pay you $3,750 as well, okay? So ignore that because there's no compounding with bonds. Just use the simple interest formula when you're asked to find the total return on the investment. Just do the simple interest formula, okay? All right, one more thing we're going to touch on is something called a mutual fund. Now, this is something that a lot of people do because it's like counting on experts who might have bought shares in varieties of stocks, okay? And then you're kind of contributing money to this fund that allows them to buy these various stocks, okay? So sometimes things like your 401k, you might have that in something called a mutual fund. So that mutual fund can contain a lot of different types of things. It can have stocks in it, it can have bonds, money market, things like that. So this investment company gets money from people like us and then uses our money, okay, to invest in a variety of different types of investments like stocks, bonds, money market instruments. And then that is called a mutual fund, okay? So it's a little, you have to figure out what one share in the mutual fund would be, can be a little strange. So that's what this formula does, the net asset value of a mutual fund. What it does is it takes into account all these different types of investments, the total amount, assets are good things, the total amount of assets they hold. Then it considers the negatives, okay? Liabilities, things they owe, okay? Like if there's any debt okay, or other things that they owe. And then the N is the number of shares, okay, that are outstanding, that have been purchased, really. And then you calculate the net asset value by taking the good stuff, how much they have, minus what they owe, divided by how many shares have been sold. And that tells you what one share in that mutual fund would be. Okay? So like if I make a routine contribution to my retirement account, which is then used to buy into a mutual fund, then whatever the net asset value is that day that I'm buying, that I'm putting that money into my account, would determine how many shares I can purchase. Okay, so our job is to figure out the net asset value. So for this one, they have 520 million. I'm going to go ahead and write out those 6 zeros in stock. They also have $700,000 in cash and 300,000 other stuff, other good stuff. So it could be bonds or some other things. All right, but then they have 4 million in liabilities. So that needs to be subtracted. Okay. All right. And then there were a total of 30 million shares. Okay. So there's the 30 million shares. So the net asset value can be found by adding the 520 million, the 700,000, the 300,000, okay, and getting that, and subtracting from that the 4 million. Okay, so when I do that, I find out that, I didn't divide. I want to go ahead and divide. Let me do it again. So 520 million. Make sure I have the correct number of zeros. 1, 2, 3, 4, 5, 6. Okay, 520 million. 1, 2, 3, 4, 5. I need one more zero. Plus 700,000 plus 300,000. Those were all good things. Then I'm subtracting the 4 million. Okay. And then once I get that, I'm dividing it. I hit enter, and then I divide that by 30 million. How many stocks were sold? And when I do that, this turns out to be about $17.23 per share. Okay? That's the net asset value. So here's how that would be used. So say I had $1,000 that I wanted to use to purchase, to put into this mutual fund. Then that means if I had $1,000, so if I had 1,000 that I wanted to invest in this mutual fund, then I could purchase a number of shares. And how to figure out how many is I could take the 1,000 I had and divide by how much each share costs. So I could take that 1,000 and divide by the $17.23. Each share would be, the number of shares would then be around 58 shares. Okay, so if I bought into it on a day when the net asset value amounted to $17.23, and if they asked me to do this, I could calculate how many shares I could purchase, and it would be 58 shares. Okay, if I were investing 1,000. But the question to net asset value is just the $17.23. All right, so I've also included here just a comparison why some people like mutual funds rather than stocks and bonds. So you can read through that. It's pretty simple. Things are diversified. Like if I had all my money in, say, Tesla, and something happens and people start not liking Tesla, then I might lose a lot of money. Okay. By the same token, if something good happens, then I would make a bunch. But it might be risky to have everything in one or two stocks. So mutual funds allow you to have your money in a variety of investments. Okay. Somebody professional, somebody knowledgeable would be managing that, right? So it's simpler for me. Right? The disadvantages to mutual funds would be that I got to pay for that person to professionally manage it, right? And sometimes it can be quite a bit, all right? And sometimes the manager, maybe their values or what they're doing might be different than what I would like for them to do. Maybe they're less risk averse than I am. I like nice, safe things, and they're doing very risky things. Okay? So there are advantages and disadvantages. I just want to include a little bit about that. All right, let me go ahead, even though it's getting long here, let me go ahead and do this one last thing. All right. To be able to compare investments, this is kind of like effective annual yield that we did with Section 13.2. It's very much like that. Sometimes we just want to be able to compare, the return on our investments, okay, so that we can get, have a good sense of, or know which thing we should invest in. So an annual rate of return, it's like effective annual yield, would be good to know. Okay. So it's not just the percentage return, but it's in 1 year. What is our percentage return? All right, so there's a couple formulas here. Remember effective annual yield earlier was this formula. We used it back in Section 13.2 when we had like maybe an account where they were compounding your money monthly, when they were calculating the interest, and we wanted to be able to have a sense of how that compared to another account that might have different terms, okay? All right, and then this is a version of that formula that we can use when the interest rate is monthly instead of annual, and when the dividends, okay, the interest that we earn, when those are reinvested into the account 12 times during the year, okay? So this is going to be the one that we're going to be using today in this problem, because here we own shares of a mutual fund, and the only return the fund earns is dividends of 5% per month. So it's a monthly interest rate, and these are reinvested. So it's this scenario here, okay? Monthly interest rate, the dividends are being invested, and we want to know what our annual rate of return is. So that's really that effective annual yield, okay? So what we're going to do here is we're going to take 1 plus the interest rate per month, which we happen to already have. So that's this. We don't need to divide by 12 because the R in this formula was the annual rate, but we're being given the monthly rate. This is the monthly rate already. Okay, so that I'm going to plug in that 0.005. I'm going to change that into a decimal by moving the decimal 2 places to the left. I'm putting that in place of the rate with that little m, which means monthly. Okay, so this right here is the monthly interest rate. Okay, so it says to put in the monthly rate. You're going to raise that to the 12th power and then subtract 1. So when I do that, this turns out to be 1.06168 about. When I take away 1, okay, that's going to turn out to be just 0.06168, which is about 6.2%. So that annual rate of return on that mutual fund would be 6.2%. So that would allow me to compare it to other investment opportunities like what I could make if I put it in a bank account, and other possibilities like that.